Today, New Zealand Central Bank lifts interest rates by 0.5%. Hi again, it's Martin North from Digital Finance Analytics. Well, notice posts covering funds and problem news with a distinctively Australian and New Zealand perspective. Well, New Zealand Central Bank raised its key interest rate by 0.5 percentage point today.
The Monetary Policy Committee increased the official cash rate from 4.25 to 4.75%. The committee agreed that the official cash rate still needs to increase, as was indicated in our November statement, to ensure that inflation returns to within our target range over the medium term. While there are early signs of price pressures easing, core price inflation remains too high, employment is still beyond its maximum sustainable level, and near-term inflation expectations remain elevated. Cyclone Gabrielle and other recent severe weather events have had a devastating effect on the lives of many New Zealanders, and it is too early to accurately assess the monetary policy implications of these weather events, in particular given that the scale of the destruction is really just unfolding with us now. The timing, size and the nature of funding of any government fiscal response is still yet to be determined. However, the committee's current assessment is that over coming weeks, prices for some goods are likely to spike and activity will be weaker than previously expected. Export revenues will be negatively impacted. Monetary policy, of course, is set with a medium-term focus, and the committee will look through these short-term output variations and direct price effects. In time, the infrastructure and community rebuild will add to activity and inflation pressures, especially given the existing capacity constraints in the economy.
That's slowing its pace of tightening as borrowing costs reach a level where they begin to, quote, weigh on demand in the economy. The Reserve Bank lifted the official cash rate to 4.75% on Wednesday in Wellington. Actually, that was predicted by most economists. It maintains a forecast peak rate of 5.5% while expecting it to take a quarter longer to reach that level. The downshift from a previous outsized 75 basis point hike brings the Reserve Bank closer to global peers that have slowed the pace of tightening as inflation and job markets ease. But a half-point move puts it at the upper end of recent increases, with the Federal Reserve switching to a quarter point this last month. The Reserve Bank of New Zealand will further ease the pace of hikes to 25 basis points at the April meeting, alongside further easing in demand pressures and global inflation before pausing, Goldman Sachs said in a research note. Risks are skewed to a more elongated hiking cycle. Traders are pricing in a 40% chance of another half-point increase at the central bank's April meeting, and others like Goldman argue that the Reserve Bank of New Zealand has scope for smaller moves as it has longer to reach the terminal rate. But all options were on the table and will be on the table, Adrian Orr said to reporters. We've come a long way and fast, he said after the decision. Now that we're confident we're in a restrictive position, we're afforded more time to reflect on whether we're seeing the outcomes we are hoping to see by now. New Zealand is still responding to the shock of Cyclone Gabrielle, which destroyed infrastructure, flooded homes and displaced thousands as it cut across the upper North Island last week. Orchards and food-producing regions were devastated, suggesting near-term shortages and price spikes. And there was a very interesting set of comments from Adrian Orr relating to the importance of cash, especially in an emergency.
Well noted is resilience in our banking system. You know, our drive to cashless society shows how vulnerable we are. This is why we have been doing the work on cash and cash distribution throughout the economy. So de-risking, de-branching, pricing, cash management out of use increases risk, reduces resilience. It is real, it is happening. We need to both mitigate and adapt to the climate change that's going on. So this work is critical for our monetary policy, our financial stability, and even through our cash management operations, as you've seen. So it is a critical component, as is financial inclusion. You're seeing and reading some horrific stories out there at the moment of isolated communities. When people lose the ability to transact, when they don't have a means of exchange, then social cohesion is very quickly challenged. And so these are vivid reminders right now of the importance of resilience through the system. We could go on for days across almost every sector of the international economy at the moment, where just-in-time management has been taken to extreme and just-in-case management has been left in the background. So a good, horrible wake-up call.
And the RBNZ said it's too early to accurately assess the monetary policy implications of the storm. The Treasury Department said on Tuesday that the rebuild of homes and infrastructure will add demand to an already capacity-constrained construction industry and lead to general nationwide inflation pressure. So that could result in the RBNZ keeping interest rates higher for longer, it said. The central bank's updated forecasts were little changed from those presented last November. They show the official cash rate rising to 5.5% in the fourth quarter of 2023, then gradually declining from the third quarter of 2024. Deterioration in the global and domestic economies, together with easing global inflation, are likely to prompt the RBNZ to soften its hawkish stance and reverse course potentially as soon as late 2023, Bloomberg said. The Reserve Bank of New Zealand reiterated that it expects the economy to enter recession in the second quarter of this year, but then to bounce back to growth a little earlier next year. And inflation will be slightly firmer than previously expected through to the second half of 2023, according to the Reserve Bank's latest projections. Consumer price growth will return to the top of the central bank's 1 to 3% target by the third quarter of 2024. That's actually unchanged from the previous forecast. But the point here is straight shooting Adrian Orr really does spell out the problem. You have to engineer a recession to be able to get inflation under control. And because of the cyclone damage also now coming over the top, that could put more inflation in the frame ahead. So don't expect significant reversal from the Reserve Bank of New Zealand anytime soon. But the final point to make is that he did say that the mortgage rates out there in New Zealand actually already reflect pretty much the rises that he's now forecasting. In other words, the market is already forecasting in these higher rates, so there might not be a massive mortgage shock down the track. But we'll see. Bottom line, of course, is as rates continue to rise, property prices will continue to fall, and the New Zealand economy will continue to languish. And remember, Adrian Orr is trying to engineer a recession. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.